You can feel it, right? That weird tension in the air when a market stops acting normal and starts acting like it's got a mind of its own. Silver didn't just move today, it slapped the table, flipped the script, and forced a whole lot of people to stare at their empty hands and whisper, I shouldn't have sold. And real quick, my analytics keep showing the same thing. A ton of you watch every video and you still haven't subscribed. If you get value here, hit subscribe so you don't miss the next move. Now here's the part most people are missing. This isn't just a price spike. This is sellers' regret turning into a stampede. And that stampede is colliding with a physical market that's been quietly tightening for years. And if you think that sounds dramatic, wait until you see what's happening behind the curtain. Because the paper price and the real world price are starting to look like they live in two different universes. All right, let's talk about the eruption. If you looked away for even a few hours, silver made you pay attention. Big candles, fast moves, the kind of trading day where people who sold last week don't even want to open their apps today. And gold is acting like it's not asking permission anymore. When both metals run at the same time, that's not a cute headline. That's a message. The message is this: confidence is getting repriced. And I know somebody's already typing, it's just a pump. Okay, if it's just a pump, then explain why the people who dumped metal on a scary headline are now getting wrecked twice. Once on the move and again on the spread. Because that's the uncomfortable truth. When you sell a hard asset and panic, you don't just lose the rally. You lose the premium you paid. You lose the premium you could have captured. You lose the optionality. You lose your seat at the table. Then when price rips higher, you don't just feel oops, you feel trapped. Because buying back feels like admitting you got played. And that's how sellers' regret turns into fuel. But there's another layer, and it's the layer almost nobody in the US talks about. The metal you sold doesn't vanish. It goes somewhere. It gets vacuumed up by whoever was patient enough to wait for your fear. And from recent market updates, the appetite outside the US has been intense, especially in places where people don't romanticize paper promises the way Wall Street does. In certain overseas hubs, the local price for physical silver has been running meaningfully above what most Americans see on a screen. That gap matters not because it guarantees tomorrow's price, but because it shows you where the real Tugoff war is happening in delivery, not in headlines. Now, I want to be careful here because a lot of people hear premium and their brain goes straight to conspiracy mode. So let me frame it cleanly. Premiums can widen for multiple reasons. Shipping delays, local taxes, demand spikes, inventory mismatches, even simple market stress. But when premiums pop at the same time across multiple regions and they don't instantly collapse back to normal, that's when you should stop shrugging and start asking a better question. Is the market tight or is it tightening? And if it's tightening, what happens when the next wave of buyers shows up? Because here's the cliffhanger that should bother you. The loudest voices telling you silver is too late are often the same people who will quietly buy it after the next dip, then brag about buying weakness. They don't want you calm, they want you emotional. Emotional people are predictable. Predictable people are easy to harvest. So let's get practical and let's talk about the stuff nobody explains when you walk into a local shop. One thing I want you to understand is how buyback prices actually work in the real world. You'll see a spot number, then you'll see a bid, and then you'll see what a buyer is willing to pay you, which usually leans off that bid, not the headline spot. That difference is not automatically a scam. That's the cost of immediate liquidity. But big but, during fast markets, some places widen those spreads aggressively, sometimes because they're protecting themselves, sometimes because they're simply taking advantage of confused sellers, and sometimes because they have a liquidity issue and they don't want to admit it. So if you're ever selling or buying, don't do the walk-in, take the first number, walk out routine. Price check, compare, slow down. The fastest way to lose money in a metal market is to treat it like a convenience store. And I'm going to say something that might save you real money. If a shop suddenly refuses to buy, that doesn't prove nobody wants silver. Sometimes it proves that shop doesn't have the cash, doesn't have the hedging, or doesn't want the risk of replacing inventory at higher prices. That's why you need multiple quotes. Now, some of you asked me for a straight example of what the market looks like in a hot tape. Here's the concept without naming any specific company. You might see a government minted coin trading above spot, by a single-digit premium even when silver is exploding simply because the buyer is pegging their bid to a wholesale pipeline. You might see generic rounds bid up even more, not because they're rarer, but because they're easier to move in bulk. You might see big bars with a tighter premium because the buyer wants weight and doesn't care about designs. And here's the punchline. If you sell in a panic, you often give up the premium on the way out. And then if you try to get back in, you pay it again on the way back in. That's a double toll booth. And let me address the biggest emotional landmine in this whole rally. The rumor that nobody is buying and coin shops are full. That line gets repeated every time silver runs. And it's usually said by someone who walked into one shop, got one quote, and decided that represented the whole market. Here's what's actually happening in a hot market. Buyers are still buying, but they're picky. They'll pay up for the stuff they can flip quickly, and they'll lowball the stuff that ties up capital. That's not a collapse in demand. That's triage. So, if you want to sanity check the market, do it like an adult. Compare multiple buyback offers from multiple places, including online buyers that publish their bids. Look at what they pay for government-minted coins versus generic rounds versus big bars. Then look at what they charge on the retail side. The spread tells you how nervous the pipeline is. And here's a detail people miss. In fast moves, the premium can collapse even while the metal price rises because dealers don't want to get caught selling inventory they can't replace. So sometimes you'll see spot screaming higher while premiums tighten. That doesn't mean the rally is fake. It means the market is trying to keep product moving. Other times you'll see the opposite. Spot holds steady while premiums explode because the paper market is calm, but physical supply is stressed. That's when you should lean forward because it's a clue about where the real pressure is building. Either way, the correct response is not panic. The correct response is clarity. Now back to the math because this is where the 190 conversation gets interesting. The analyst walked me through the empirical rule, the bell curve concept you probably learned in school and forgot. Picture a center line. Most outcomes cluster near the center. As you move farther away, outcomes get rarer. One standard deviation on either side covers roughly 68% of outcomes. Two standard deviations covers about 95%. Three covers roughly 99.7%. In normal times, the tails are quiet. In stress times, the tails wake up. So when he draws those future bands, he's not promising a number. He's saying if volatility stays elevated, there's a non-trivial path to a price that would look outrageous in a calm market. And he made another point that I think is the real takeaway. When you combine elevated volatility with a confident shock, probability maps can shift faster than people expect because behavior changes. People stop selling dips. People start buying dips and then sellers disappear. That's when the math that looked like a tail can start acting like a base case. Not forever, not automatically, but long enough to create a move that makes everybody's jaw drop. Now I'm going to switch gears and run through a rapid fire feed of what's crossing traders' screens. And I want you to listen for the theme, not the details. We're seeing talk about huge industrial orders getting negotiated earlier than normal. We're seeing more chatter about physical minimums and rationing behavior in retail channels. We're seeing margin adjustments in derivatives markets. We're seeing silver-linked products trade with unusual dislocations relative to their references. Different headlines, same story, stress. And if you think the stress is only in metals, here's your next cliffhanger. The stress is showing up in bonds, in currencies, and in crypto too. This is one of those cross-asset moments where everything is connected and the market is trying to decide what it trusts. So I'm not here to scare you into buying or selling. I'm here to keep you from doing something emotional that you regret for years. Now, I asked a quantitative analyst I trust to walk me through a question a lot of you keep asking in plain English. How do you get to a big target number like 190 for silver without just throwing darts? And what he said was simple and kind of terrifying. He said, stop staring at price. Start staring at volatility because price is where you are. Volatility is how violently you can get somewhere else. Think of volatility like the speed limit of a market's mood swings. If volatility expands, the range of possible outcomes expands. That's not hype, that's math. So, we pulled up what's basically an expected move framework. It's not a crystal ball, it's a probability map. And the map works like this. You pick a time window, you measure recent volatility, and you draw bands that show where price is statistically likely to land if the volatility stays in the same neighborhood. The first band is the 1 standard deviation zone. In plain language, it's where the market lands most of the time, around 2-3 probability. The next band is the 2 standard deviation zone. That's the almost always range, mid-90s probability. And then there's the 3 standard deviation zone. That's the tail. That's the zone people laugh at until it hits them in the face. It's low probability on paper, but when the world is stressed, tails get fatter. That's when rare becomes real. So when somebody says 190, what they're really saying is under a stress scenario with volatility where it is, that number sits inside the plausible tail. Not guaranteed, plausible. Now, let me make this even more concrete. Imagine a cone extending out into the future. The cone widens because uncertainty widens. The farther out you go, the bigger the potential range. If volatility rises, the cone widens faster. That's why silver feels like it teleports. It's a smaller market than gold. It's more sensitive to flows, and it has a history of overshooting when stress hits. And yes, people use these frameworks to build option strategies. They might sell an out-of-the-money call and an out-of-the-money put, collecting time decay. They might hedge with spreads. They might run risk-defined structures. But listen, if you don't understand those tools, don't copy them just because someone said the word probability. Probability without risk control is a trap. The real value for you is understanding the range of outcomes so you don't get emotionally hijacked by a big candle. Now, the analyst also made a point that I want to underline because it explains the bigger macro story. He said, people keep calling this a reserve currency problem. That's too narrow. It's a compounding problem. And he's right. When a system runs persistent deficits, it doesn't just rack up a number. It creates a compounding interest burden. That interest burden forces more borrowing. More borrowing forces more issuance. More issuance pressures confidence. And then you're stuck in a loop where the solution creates the next problem. Even in the US, interest costs have gotten so big, they're no longer a footnote. Based on publicly available fiscal trackers, annual interest costs have pushed into the neighborhood of $1 trillion. That's not a tweet. That's a structural pressure. And when debt service becomes that heavy, policymakers get boxed in, cut rates, and you risk stoking inflation again, keep rates high, and you strain the system. Either way, confidence gets tested. And when confidence gets tested, metals get a bid. Now let's hit some of the breaking update stuff you've probably seen flying around today, because some of it is real signal and some of it is pure noise. First, the industrial side of silver is not a side story anymore. It's the story. The latest demand breakdowns show industrial use pressing to record territory even when other categories soften. Electronics and electrical applications have been particularly strong. Second, the silver market has been running structural deficits for years. Recently published industry surveys have projected another deficit year with a sizable shortfall and a multi-year cumulative gap that's hard to ignore. Translation: inventories get drawn down. And when inventories get drawn down, small disturbances turn into big price moves. Third, you may have seen chatter about major manufacturers locking in giant supply agreements tied to electronics, EV supply chains, and energy hardware. I'm not going to pretend I can confirm every viral post in real time, but the direction of travel is obvious. End users are nervous, and nervous end users don't wait for a better price. They secure metal, and when they secure metal, that demand doesn't care about your chart patterns. Now, because social media loves drama, you'll also see claims like, one country controls 90% of global silver. I'm going to push back on that, not because I'm defending anybody, but because exaggeration makes you sloppy. The silver supply chain is complicated. Mining in one place, refining in another, fabrication somewhere else, and demand scattered across industries and borders. If you anchor your decisions to meme statistics, you're building your strategy on sand. Here's a better way to look at it. Even if no single player controls everything, big buyers can still tighten the market at the margin. And in a market with a thin cushion, the margin is where the fireworks start. So yes, it's possible that large overseas buyers are pulling supply. It's possible that manufacturers are trying to lock in inventory. It's possible that financial players are scrambling to hedge. All of that can be true without the cartoon version being true. And that brings me to the mechanics, the part that explains why days like today feel insane. In fast metal moves, exchanges often raise margin requirements on futures. That's not a moral judgment, it's risk management. But it has a side effect. It forces leveraged traders to post more collateral or reduce positions. That can create violent whipsaws, up and down because the market is flushing leverage in real time. So when you see margin hikes, don't treat it as they're stopping the rally. Sometimes it slows things, sometimes it creates a dip, and sometimes it sets up the next burst because weaker hands get shaken out and stronger hands absorb. Same with dealers changing rules. When you see minimum order sizes appear, or, sorry, we can't process small orders right now, that's not random. Sometimes it's a demand surge. Sometimes it's logistics. Sometimes it's the simple reality that inventory is expensive to replace during a fast rally. And when funds pause inflows or halt trading on a silver-linked product, that's another stress marker. It can mean retail demand pushed the product away from its reference, creating a premium spiral. It can mean liquidity thinned out. It can mean the plumbing got clogged. Whatever the reason, it's a sign of stress. And stress is where price discovery gets honest. Now, you might be thinking, okay, John, but what about the sellers? Where are they coming from? They're coming from the exact same place sellers always come from, fear and fatigue. A lot of people have been conditioned to treat metals like a trade instead of a hedge. So when price runs, they sell to lock it in. Then price keeps running and they stare at the chart like it betrayed them. If that's you, I'm not judging you. I'm telling you to learn the lesson. If your reason for buying hasn't changed, don't let a fast candle bully you into a fast decision. And if you're successful, share your success story in the comments so others can stay motivated. Now let's pivot because the metal story is tied to something bigger, the bond story. For decades, bonds were treated like the boring adult in the room. Stocks were the wild kid. Bonds were the stabilizer. But lately, the stabilizer has been wobbling. When long-term yields spike, bond prices drop. That part is basic. The part that's not basic is what it does to portfolios that assumed bonds would save them during chaos. And this is where a lot of people are going to be surprised. If you built your entire strategy on the idea that bonds always offset risk, you might be living in an outdated playbook. Why? Because the world changed. When a government runs persistent deficits, it has to issue more debt. More issuance can pressure yields higher unless there's a buyer willing to absorb it. Central banks can absorb, but then you risk inflation. Private markets can absorb, but then they demand a higher yield for the risk. Either way, the old safe hedge assumption gets messy. That mess shows up right where metals live, in real rates and confidence. And it's not just America. When Japan sneezes, global bonds catch a cold. When Europe fights stagnation, their policy choices bleed into currency markets. When emerging markets wobble, the dollar gets pulled in two directions, stronger against weaker currencies, weaker in purchasing power as the whole system inflates. That's why you can see gold and silver climb without the dollar crashing in the way people imagine. Two different scoreboards. Now there's another headline floating around that's making people's eyes bug out. A big digital dollar issuer talking like it wants to be the next gold central reserve. Here's my take, and I'm going to keep it grounded. Holding gold is not the same as being a central bank. A central bank isn't just a vault. It's a settlement machine. It's a policy lever. It's a lender of last resort. So when a private company says it wants that role, you should hear it for what it is. Ambition, marketing, and maybe a signal that even the crypto-adjacent world is leaning back toward tangible reserves. That signal matters because for years, the narrative was trust the code. Now, even the code people are talking about backing with metal. That's a vibe shift. And vibe shifts are where markets turn. Still don't get hypnotized by bold claims. Ask the practical questions. How much metal is actually held? How is it verified? How liquid is it? And what happens under stress? Those questions separate fantasy from infrastructure. Now, I watched one of those mainstream segments where a host tries to explain the move with a neat little package: geopolitical uncertainty, a softer dollar, and central banks buying gold. That's the polite version. It's not wrong, it's just incomplete. Because the deeper version is that people are watching the rules change in real time. Trade policy uncertainty, tariff threats, and sudden diplomatic flare-ups don't just move headlines. They change corporate planning and sovereign planning. And when planning gets harder, demand for collateral rises. Another angle that's been quietly building is rotation. When speculative corners of the market cool off, money often looks for something with history, something liquid, something globally recognized. That's why gold can rise even when the narrative says risk on. It's not always fear, sometimes it's repositioning. And then you've got the policy theater. You hear political leaders talk about a strong dollar because it sounds good. But the market cares about purchasing power, and purchasing power cares about supply. If the supply of currency expands faster than the supply of real goods, the scoreboard changes, even if the speeches don't. Rates are the same story. Everybody wants the central bank to cut. Everybody cheers when mortgage rates dip. Everybody celebrates refinancing spikes. But the long end of the bond market isn't controlled by optimism. It's controlled by risk perception. If investors demand more yield to hold long-term debt, that pressure can stay even if short-term policy pivots. And while that two-off war plays out, you're seeing the regulatory machine start talking louder about the future of digital finance too. From recent public policy updates, there's been renewed momentum around frameworks meant to shape how crypto markets operate. That matters because it signals the system is trying to formalize the next rails, even as trust in the old rails gets questioned. So if you're sitting there thinking, why does this feel bigger than silver? It's because it is. This is about what the world chooses as a bridge between uncertainty and stability. And right now, metals are acting like that bridge. And here's another cliffhanger. If the next phase of finance blends digital rails with hard collateral, that doesn't kill metals. That could supercharge them because it increases the number of pathways that route demand into the same limited pool of physical supply. Now, while all this is happening, politics and policy chatter keeps trying to take over the narrative. You'll hear people say the dollar is weak because of geopolitical stress. You'll hear people say the dollar is strong because growth looks fine. You'll hear people say rates are going down because they have to. And then you'll watch the bond market quietly vote. And the vote won't always match the speeches. That's why I focus on incentives, not promises. Policymakers love lower rates because it makes borrowing cheaper and keeps the party going. Markets love lower rates because it boosts valuations, but lenders don't love lower rates if they think inflation is coming back. So even if the short-term policy rate pauses or cuts, the long end can still stay high if confidence is shaky. And if that happens, the soft landing story gets harder to sell. This is why comparing today to 1980 or 2011 is lazy. Back then, the world was not as financially connected as it is now. Back then, industrial demand for silver was not tied into today's electrification push and high-tech supply chains the same way. Back then, the debt load and the speed of information were different animals. And here's the biggest difference. The market has been living in deficit mode. When total silver demand sits around 1 billion plus ounces a year and the market runs repeated deficits, it changes the backdrop. It means rallies aren't just speculative froth. They can be inventory stress expressing itself through price. Now let me challenge something else. The idea that parabolic means it must crash. That's a rule people repeat because it sounds smart. But markets don't crash because they're high. They crash because they're overcrowded with leverage and the marginal buyer disappears. Could we get a brutal pullback? Absolutely. Metals are famous for ripping your face off both directions. But a pullback is not proof the thesis is dead. A pullback is the market checking who's real. So if you're watching silver at triple-digit prints and thinking, I missed it, slow down. The goal isn't to time the perfect tick. The goal is to build a position you can live with through volatility. That's why I keep saying scale in, don't chase, don't panic. Have a plan before your emotions write one for you. And I want your take in the comments. Do you think this move is being driven more by industrial demand or by financial stress? Now, there are a few more developments that fit into this same puzzle, and I want to run through them fast because they matter. When online dealers start changing rules, minimum order sizes, tighter buybacks, longer ship times, that's not random. Sometimes it's a demand surge. Sometimes it's logistics. Sometimes it's the simple reality that inventory is expensive to replace during a fast rally. When short sellers cover, it can create those sudden vertical candles that feel unreal. And yes, you'll see stories about a big trader losing millions. That might be true. It might be exaggerated. The point is, crowded shorts in a hard asset market can unwind violently, and the unwind doesn't care about your feelings. When a major institution pauses a product because retail demand is pushing it away from its underlying reference, that's another stress marker. It tells you people are reaching for exposure, and reaching is what happens when confidence fades in the alternatives. Now, let's widen the lens with some fresh context that matters for the next chapter. Silver isn't just money metal.